Yes, people. Good morning, good afternoon, good evening to all South India student. How are you? Hope so you are good. I am also good. Good evening to all of you. Yes, sir. Good evening, sir. Good evening. Okay, guys. So in the last lecture, we have discussed one topic. Today we have to start with the new topic. So which topic today we will start? Yes, people. Good morning to all of you. Sir, good evening. Good evening, sir. Good evening. Good evening to all of you. So, guys, today we will do one topic. Hope so you did the deduction topic question. Now, today first we will complete one small topic. And that small topic is topic number 4. And topic number 4 is related to the Dispute Resolution Committee. Dispute Resolution Committee. That is topic number 4. Dispute Resolution Committee. Good evening to all of you. Yes, directly check. Topic number 4 is of Dispute Resolution Committee. Now, guys, you know that suppose all people pay attention. Suppose assessing officer pass any order, means assessing officer pass any order, or suppose you received any intimation, then guys, if you are not satisfied with this order or intimation, then you can file the appeal to the either Joint Commissioner appeal or the CIT appeal. So guys, appeal option is available. So if you received any order of the assessing officer, assessment order under section 143(3) or 144 or 147, and if you are not satisfied with this order, then you can file appeal to the JC appeal or CIT appeal. But guys, if you don't want to file the appeal, then there is a one more remedies available to assessee, and that remedy option name is a Dispute Resolution Committee. This is called your DRC, or you can say that the Dispute Resolution Committee. And guys, in Dispute Resolution Committee, you can file the appeal in case of the small cases. Small cases means, it means suppose in order of AO or intimation, there is a variation in the income, and that variation is only up to rupees 10 lakh. Means variation is up to rupees 10 lakh, means 10 lakh or less variation. That variation is not more than 10 lakh. There is a variation of only up to rupees 10 lakh. So first is a in order of AO or in the intimation, there is a variation, and that variation is only up to rupees 10 lakh, means variation is up to rupees 10 lakh. And guys, if assessee filed the return, then as per his return income, that return income was only 50 lakh rupees. So if there is a small case means variation made by assessing officer is only up to rupees 10 lakh. And guys, his return income was up to rupees 50 lakh, means it was not more than 50 lakh. Then there is an option, instead of going to the appeal to the Joint Commissioner appeal or CIT appeal, directly you can file application to the DRC. DRC means Dispute Resolution Committee. Dispute Resolution Committee, and what they will do, you know that either they will change your variation, means whatever variation, like variation made by the assessing officer, they will change the variation and they will give you the relief in that. Or guys, they can give you the immunity. Immunity means in Hindi we call it the maafi. So immunity in the penalty as well as the prosecution. So if there is any penalty or prosecution, then they can give the immunity in the penalty or prosecution. So this concept is called your DRC. DRC means Dispute Resolution Committee. So guys, here you know that we have discussed one DRP concept, Dispute Resolution Panel. That was different. The Dispute Resolution Panel, that was different. That is applicable in case of the, if any non-resident or foreign company, suppose assessing officer made the variation, or suppose if any assessee case was transferred to the TPO, transfer pricing officer, and due to the transfer pricing officer there was a variation. So that was applicable in case of the only that type of assessee. But guys, here this DRC concept, dispute resolution committee concept, is applicable in case of the assessee where AO made the variation, that is very small variation, up to 10 lakh AO made the variation, and guys, he filed the return. In that return, income was only 50 lakh rupees. Up to 50 lakh was the return income. So in this particular case, you may file the application to the DRC, and if you file the application to the DRC then there will be a 1000 rupees fees. There is a fees of 1000 rupees. With the fees of 1000, you can file the application to DRC instead of filing the appeal to the Joint Commissioner Appeal or CIT appeal. You got my point or not? Yes, we will read one by one. Now question is that who will constitute the DRC, Dispute Resolution Committee? So pay attention. Section 245 MA subsection 1, this section says that constitution of the Dispute Resolution Committee, who is going to constitute the DRC? So guys, our central government is going to constitute the DRC. So central government constitute one or more DRC. Now DRC shall resolve the dispute of the class of person which shall be specified by the board. So board will specify that which dispute will be resolved by the DRC. Now assessee would have an option to opt for or not opt for the dispute resolution through the DRC. Now dispute should arise from the any variation in the specified order. If there is any specified order then only you can file the application to the DRC, and there is a variation in the specified order for any assessment. Now guys, constitution, the central government would constitute the DRC for every reason of the PCCIT for the dispute resolution. So in India, they have divided India in the various PCCIT region. So principal chief commissioner of income tax region. So in every region, they will constitute one DRC, that is dispute resolution committee. But question is that in DRC, how many judges will be there? So pay attention. Composition. So every DRC would consist of the 3 member, means there will be 3 judges in the DRC. Now 2 member would be the retired officer from the IRS, income tax, and who have held the post of the CIT or any equivalent or higher post for the 5 years or more. So out of the 3 judges, means there will be a 3 judges panel, and out of the 3 judges there will be a 2 officer of the IRS, income tax, retired officer, 2 member, and guys, they have held the post of the CIT or any equivalent post or higher post for at least 5 years. That person will be appointed for as a 2 member will be that person, and 1 will be the serving officer of the income tax not below the rank of the CIT PCIT, means 2 retired officer and 1 serving member, total 3 member will be the judges in the DRC. Now member would be appointed by the central government for the period of the 3 years, and guys, decision of the DRC shall be given on the majority basis, and central government may remove any member after giving an opportunity of being heard. So after giving opportunity of being heard, they may remove any member. So in DRC basically, now question is who will constitute the DRC? Central government will constitute the DRC. In DRC there will be a 3 member, 2 member will be the retired officer of the IRS, income tax, and they were held the post of the CIT, PCIT or any higher post for the at least 5 years. And guys, here 1 member will be the serving member of the income tax office, and that person is hold the post of the CIT, PCIT. There are 3 member, tenure will be of the 3 year, and guys, majority decision will be given on the majority basis, and central government may remove any member after giving opportunity of being heard. Now how you will make the application to the DRC? So pay attention. Application to DRC for the dispute resolution. So guys, a specified person, now who will be the specified person? Here I will explain you. A specified person has to make an application for resolution of dispute before DRC in the form number 34 BC. So there is a one form, that is form number 34 BC. In form number 34 BC, you have to file the application to the DRC within the 1 month from the date of receipt of a specified order with the fees of the 1000 rupees. So whenever you receive the order, guys, you know that appeal filing fees is also 1 month. Like CIT appeal or Joint Commissioner appeal filing fees is also 30 days. So guys, here time limit is also 1 month. So within the period of the 1 month from the date of receipt of the specified order, you have to file an application to the DRC, Dispute Resolution Committee. Now, which order, specified order means which order can be challenged at the DRC level? So here guys, specified order means order satisfied the following conditions. So that order should be satisfied the following condition. First condition is the order should be specified by the CBDT, means order should be specified by the CBDT, and here specified order by the CBDT. So first we will discuss that which order can be challenged at DRC level. So try to understand. Here guys, order specified by the CBDT says that any draft order with the variation as referred under section 144C subsection 1. 144C subsection 1 is related to, you know, that if any foreign company or non-resident, if any order is made by the income tax department, or any person whose case was transferred to the TPO, and due to TPO there is a variation, and guys, always they will send you the draft order under section 144C. So they will send you the draft order. You have an option. Either you can file the acceptance to the AO, or you can file the objection to the dispute resolution panel. That DRP was different part. So guys, against that draft order, if you don't want to file the objection to the DRP, then here against that draft order, you can file the application directly to the DRC also. DRC means dispute resolution committee. So here guys, against dispute resolution committee, you can file the application. So first point says that any draft order with the variation as referred under section 144C subsection 1. So 144C subsection 1 is the variation in the draft order and referred under section 144C. So suppose if you receive the draft order means guys that 2-person case is non-resident foreign company or any person case was transferred to the TPO, and due to TPO order there is a variation. So directly you can file the application to DRC, dispute resolution committee, instead of the objection to the DRP. So you have an option. Either you can file the objection to the DRP, or you can file the appeal to the CIT appeal, or joint commissioner appeal, or directly you can file the application to the DRC. This is about the dispute resolution committee. Now second is, suppose if you received any intimation under section 143(1), intimation means normal intimation, or any TDS TCS intimation. TDS TCS intimation means section 143(1). 143(1) is a normal intimation, 200A is a TDS intimation, 206CB is a TCS intimation. So if you received any intimation, that is TDS TCS intimation or normal intimation, directly you can file the application to the DRC. Now the next part. Or suppose if you receive any order of assessment or reassessment, except an order passed as per the direction of the DRP. Guys, suppose assessee filed the application to the DRP, dispute resolution panel, then dispute resolution panel will give the direction to the assessing officer. Assessing officer will pass the final order. Against that final order, you cannot file the again application to the DRC. Against draft order, here option was given that against draft order you can file the application to DRC. But suppose if you receive the final order, again final order, you cannot file any application to the DRC. So here, otherwise, if there is any other assessment order or reassessment order, you can file the application to DRC. But exception is if any final order is passed with the direction of the DRP, dispute resolution panel, again that order you cannot file the appeal or application to the DRC. Now next part. If there is any rectification order under section 154 having the effect of the enhancing the assessment or reducing the losses, suppose your income is increased or your losses is reduced, in that particular case, rectification order, you can file the application to DRC. Now next part. Suppose if there is an order under section 201 or 206C 6A, that is deeming a person an assessee in default. Now assessee in default, suppose if you have not deducted the TDS, or if you have deducted the TDS but not paid the TDS to the government. So either you have not deducted the TDS or you deducted the TDS but not paid to the government. Then guys, you will be treated as assessee in default. So suppose they have treated you assessee in default. So against that particular order also, you can file the application to DRC. The variation in the specified order relating to the default in TDS TCS would refer to the amount on which tax has not been deducted or collected. So here guys, that variation should be up to 10 lakh, means on the amount on which you have not deducted the TDS or TCS, that should be up to 10 lakh. Because variation should be up to 10 lakh, then only you can file the application to DRC. So guys, here that variation amount means amount on which you have not deducted the TDS or TCS. Variation in the specified order relating to default in TDS TCS would refer to the amount on which tax has not been deducted or collected. So I can say that these are the specified order. Against this order, you can file the application to DRC. Which are the order? First is a draft order under section 144C. Second is a intimation, TDS, TCS intimation or normal intimation. Third is a any assessment, reassessment order. Fourth is a any rectified order. And fifth is a order under section 201, that is assessee in default. If you have not deducted the TDS, not collected the TDS, then you can file, like if they treated you assessee in default, then again that you can file the application to the DRC. So here, first condition is order specified by the CBDT. So order specified by CBDT are this order. Now second condition is Aggregate amount of variation in that order is up to 10 lakh, means very small case. Your variation made by assessing officer, that is only up to 10 lakh, then you can file application to DRC, sorry. And guys, order is not based on any search initiated under section 132 or requisition made under section 132A in case of assessee or any other person, or order is not based on any survey under section 133A, or order is not based on information received under DTAA under section 90 or 90A. It means, guys, suppose department made the order and this order is based on any search, that is raid, or requisition, or any survey, or any information received under section 90 or 90 under DTAA, then against that order you cannot file the appeal. So what I am saying that here, okay, guys, if order is made by the assessing officer and order is based on the search or requisition or survey or information received under the DTAA under section 90 or 90A, so against that order you cannot file the application to DRC. Now, third condition, where return has been filed by assessee, then total income as per return up to rupees 50 lakh. If this all the conditions are satisfied now, then assessee can file the application to DRC. So guys, just remember that when you can file the application to DRC, first condition is order is a specified order, means this order. Second is a order not passed on the basis of the search or survey or information received under section 90 or 90A. Third condition is variation should be up to rupees 10 lakh, and if you file the return, then as per return your income was up to rupees 50 lakh. If all the conditions are satisfied, then guys, against that order you can file the application to DRC, Dispute Resolution Committee. Now, there are certain negative lists, and they are saying that this person will not be able to file application to the DRC. Means following person not eligible to file the resolution. So this person will not able to file the application to DRC. Now, which person? First is, in respect of whom an order of detention has been made. An order of detention has been made under Conservation of Foreign Exchange and Prevention of the Smuggling Activity Act 1974. So guys, there is a one person, and against that person, suppose order of detention has been made under Conservation of Foreign Exchange and Prevention of the Smuggling Activity Act 1974. So again, that person, suppose if any order of detention has been made under this particular act, Smuggling Act, then that person is not able to file the DRC application. Second is, in respect of whom prosecution has been instituted. Means prosecution means jail has been instituted and has been convicted of any offense punishable under the following act. Suppose he is convicted, means prosecution has been instituted and that person has been convicted under the offense punishable under the following act, either Indian Penal Code 1860 IPC, or Unlawful Activity Prevention Act 1967, or Narcotic Drugs or Psychotropic Substance Act 1985, or Prohibition of Benami Transaction Act 1988, or Prevention of the Money Laundering Act 2002, or Prevention of the Corruption Act 1988. So guys, if any person, again, whom prosecution is already instituted and he has convicted under any offense under this act, that is IPC, or Unlawful Activity Act, or Narcotic Drugs, or Prohibition of Benami Transaction, or Money Laundering Act, or Corruption Act, then that person cannot file the application to the DRC. So this is like a bad people now. So like these people are bad people. If anyone is convicted under this act na for any like offense, then guys, that person not allowed to file the application to the DRC, Dispute Resolution Committee. As well as if any person is already detention has been made under Foreign Exchange and Prevention of Smuggling Activity Act 1974, then that person cannot apply for the DRC. Now, next part. Guys, in respect of whom prosecution has been initiated under IT authority, like prosecution is already initiated under IT authority for any offense punishable under the provision of the Income Tax Act or the Indian Penal Code, or for the purpose of enforcement of any civil liability under any law for the time being in force, and such person has been convicted of any offense consequent to the prosecution initiated by IT authority. So guys, under income tax also, suppose if that person against whom prosecution is already been initiated, prosecution means jail, is already been initiated, then against that person is not eligible to file the appeal to the DRC. Now, next part. Next person is who is notified under section 3 of the special court trial of offense relating to the transaction in the Security Act 1992. So there is a Security Act 1992, and again in that particular act, under section 3, there are certain person who are notified by the special court. So that person are not eligible to file the application to the DRC. Now next part. Proceeding under black money or undisclosed foreign income and asset, that Black Money Act of the 2015, have been initiated for any assessment year for which resolution of dispute is required. So in simple word, suppose if for that particular year, if there is a Black Money Act is already they have activated, means proceeding under the Black Money Act, proceeding means assessment under the Black Money Act is already started, then guys that person for that previous year cannot file the application to the DRC. So guys, these people are not a good people, you can say that. So these people are not a good people. They are not eligible to make an application to the DRC, Dispute Resolution Committee. Now, if you file the application to the DRC, then what DRC will do? Suppose if you file the application to the DRC, then what DRC will do? So there are some procedural part related to the DRC. So we are checking the procedural part. First is you will file the online application. Against any order, against this particular order, you will file the online application to the DRC. So what will happen? Now how DRC will proceed? Try to understand. First, they will screening the application by DRC. So DRC will screen your application. What they will do? First, they will examination of the application, means they will examine your application. Now DRC has to examine the application. Upon such examination, where DRC considered that the application should be rejected, then it has to be serve a show cause notice as the why application should not be rejected. So guys, when you file the application to DRC, DRC will check that. They will examine the application, and after that, if DRC feel that your application should be rejected, then they may reject your application, but before that they will give you show cause notice. They will give you show cause notice. They will give you opportunity of being heard why your application should not be rejected. Now what will happen in the next line? Try to understand. Provision of the opportunity of being heard. Now assessee can request for an opportunity of being heard. Then DRC has to provide opportunity of being heard through the video conferencing facility. So there will be a faceless this part also. So guys, you can request ke sir, we want to submit our oral submission. In that particular case, they can provide you the opportunity of being heard through the video conferencing. So they will provide you the video conferencing facility, and through that you can explain your case. Now next part. Furnishing response to the show cause notice within the specified date. So whatever show cause notice they have given, you have to furnish the reply. So here assessee has to furnish a response to the show cause notice within the specified date and time, or such extended time as may be allowed by the DRC. Now next part. Rejection of application by DRC. DRC may reject your application. So here DRC may, after considering the response furnished by the assessee, they may reject the application or allow the application. And where no response is furnished by the assessee, DRC may reject the application. Guys, either they may reject the application or they may accept your application. But suppose if you not file the response only, then there may be possibility they will reject your application. Now guys, in such a case, the assessee may file appeal to the Joint Commissioner Appeal or CIT appeal. And whatever time wasted in the time taken by DRC in deciding that admission has to be excluded from the period available to file such appeal, because on the first line only what I told you, okay guys, either you can file the appeal to the Joint Commissioner Appeal or CIT appeal. Suppose you have filed the application to the DRC. So guys, if you file the application to DRC, then obviously you will not file the application to JC or CIT appeal. Now suppose DRC rejected your application. So when DRC rejected your application, then you will file the appeal to the either JC appeal or CIT appeal, because DRC is not allowing you. In this particular case, whatever time taken by DRC from the date on which you made the application till the date on which that application is rejected by DRC, that time will be excluded for the computing the time limit to file the appeal to JC appeal or CIT appeal. Because you know that JC appeal or CIT appeal can be filed in the 30 days. So while calculating that 30 days time, like time lost in the DRC proceeding, that will be excluded. You got my point or not? Yes. Now next part. All people pay attention. Now communication of decision of the DRC to the assessee. So decision of DRC allowed or rejected has to be communicated to the assessee on his registered email ID. So online only you will get the response that your application is accepted by DRC or rejected by DRC. Now, submission of proof of withdrawal of appeal or application before the DRP. Either appeal or withdraw the application before the DRP. Guys, there may be possibility. Now, suppose for an example, when DRC has accepted your application, then obviously you cannot file the appeal to the JC appeal or CIT appeal, or against that draft order, guys, that DRP appeal is also not possible, because DRP, you know that objection, that is not possible. When DRC has accepted your appeal application, so guys, here you cannot file any appeal, as well as you cannot object at DRP level in case of that draft order of the non-resident foreign company and all. So that DRP is not possible. So here, guys, you have to submit the proof of withdrawal of any appeal you already filed. So here what they are saying, submission of proof of withdrawal of appeal or application before the DRP, dispute resolution panel, they are saying. What they are saying here, pay attention. Okay, within the 30 days of receipt of the communication that application is admitted, the assessee is required to submit the proof of withdrawal of appeal of the CIT appeal or withdrawal of application before the dispute resolution panel, if any, to the DRC, or convey that there is no aforesaid proceeding pending in this case. If the assessee fails to do so, the DRC may reject the application. So guys, either there may be possibility that suppose assessee has filed the appeal to the joint commissioner appeal also, CIT appeal, joint commissioner appeal, or CIT, and also you have made the application to DRC. So suppose DRC accepted your case, accepted your application, then you have to withdraw this appeal, or you have to give one declaration that sir, there is no appeal pending with the JC appeal or CIT appeal. Done. Now next part. What next part says? Try to understand. Procedure to be followed by the DRC. Now what DRC will follow the procedure? Your application is accepted now. Now DRC will do. What DRC will do? First is DRC calling for the record for further examination. So DRC has the power. The DRC may call for record from the IT authority, means they will ask IT authority to give some record related to assessee, and also report from the assessing officer as it may deemed fit with respect to the issue covered in the application. So they will ask the assessing officer to prepare one report and send that report to the DRC. Second is calling for the further information. Suppose DRC may, before disposing of application, call for further information from the assessee or any other person by sending the email on his registered email ID. Suppose DRC want more information, then they will send you the notice online only. That note, in response to that notice, you have to submit the information as well as some detail and all. Now next part, submission of the response within the specified time. Now assessee has to reply it. Assessee has to electrically submit its response to the DRC within the time specified, and such time as may be extended by the DRC. So guys, whatever time is given by the DRC, you have to respond that, you have to give the detail and information and all. Now next part is the decision of DRC. So here guys, DRC will give the decision. Now how DRC will give the decision? So try to understand. Suppose for an example, you have filed the return, and guys, in your return your income was 40 lakh rupees. Your income was 40 lakh. Suppose you filed the return, your income was 40 lakh. After that, AO made the variation and AO increased your income to 47 lakh. So assessee can file the application to DRC. Answer is yes. So AO made the variation of the 7 lakh and AO says that your income is 47 lakh. Now assessee is with the DRC. What DRC can do? So here, after considering the material available on record, DRC may decide to make the modification in the variation. So guys, in the variation, they will make the modification. So guys, suppose here AO made the variation of the 7 lakh. There may be possibility that DRC will say that, okay, your 7 lakh is removed, or 7 lakh is reduced, or suppose there is like 7 lakh is reduced to the 3 lakh or 2 lakh or 5 lakh or whatever. So DRC can make the variation in that 7 lakh. Now, so here, what DRC will do? After considering the material available on record, DRC may decide to make the modification to the variation and in the specified order, and which are beneficial to the assessee. So they will, like always, they will reduce your income. So DRC will make the modification, and that will be for the beneficial for the assessee. And also they decide to waive the penalty or give the immunity from the prosecution. They will give you the immunity, means they will waive the penalty. Okay, penalty will not be applicable, as well as they may they give the immunity from the prosecution and pass an order of the resolution. So they will pass the resolution order. Or guys, they will not make any modification to the variation. Means in variation, they will not make any modification. Means they will say that okay, your income was 47 lakh, your income is still 47 lakh, but we are giving you the benefit of waive of the penalty. Means they may waive the penalty, or they may give the immunity in the prosecution. So here they will not reduce the income. In the second point, in the B point, guys, they will not reduce the variation, but they will give you the benefit in the waive of the penalty. So here, to make the modification to the variation in the to make the modification to the variation in the specified order. But guys, however, DRC may decide to waive a penalty or grant immunity from the prosecution and pass an order of resolution, and such an order will be treated as an order not prejudicial to the interest of assessee. Guys, what they will do? They will not make any variation, modification in the variation, but what they will do? They will waive your penalty. They will grant you the immunity in the prosecution, that there will not be any jail and all. And guys, that order will not be treated as harmful for the assessee, because they are giving you some benefit now. They are waive up your penalty. They will give you grant immunity from the prosecution, and that order will not be treated as the harmful for the assessee. And last is to not make any modification in a specified order. They will not modify any specified order. They will not change anything. And pass the order of disposing of the application, means they will directly just pass the order. They will not do anything. Means they will not give you any immunity in the penalty. They will not give you any immunity in the prosecution. They will not reduce the income also. And guys, such order will be treated, and such an order will be treated as not prejudicial to the interest of assessee. That order will also be not treated as harmful for the assessee. That order will also be not treated as the harmful for the assessee. That is not a harmful for the order of the assessee. And guys, they will pass this all order within 6 months from the end of the month in which application is admitted by the DRC. So suppose DRC admit the application in current one, then from the end of that month, within 6 months, they will pass the order. So either here, A is the best part. They will reduce the variation, as well as they will give you the immunity in the penalty and prosecution. Here, they will not make any modification in the variation, but they will give you immunity of the penalty prosecution. Here, they will not do anything. And then also this order will not be treated as harmful for the assessee. Now guys, they will serve copy of order to the AO and assessee. So DRC has to serve a copy of order of resolution or not disposing of the application to the assessee, and also to AO giving effect of the same. So they will give the give the copy of order to the assessee as well as the assessing officer. Now, no appeal or reference will be lie against the modified order. Now guys, like whatever order is passed by the DRC, now this order will be sent to the AO. Now AO will pass the modified order. Now AO will change the order according to the DRC order. Now when AO change the order according to DRC order, like suppose here in this particular example, suppose assessing officer passed the order, and guys, you apply to the DRC pass one order, and according to the DRC order, AO will modify his order. So question is that, can now against the modified order of AO, can you file any appeal to the CIT appeal or ITET or High Court, Supreme Court? Answer is no guys, you cannot file any appeal. It is not possible to file against the appeal against the modified order as well as against the DRC order. So appeal is not possible. Here appeal is not possible, means against DRC order as well as the AO that modified order, because AO will modify the order according to the DRC order. So here against modified order, you cannot file any appeal or reference. Any appeal or reference is not possible. So here, where the specified order is an order eligible for assessee under section 144C subsection 1, means earlier it was a draft order in case of foreign company or non-resident, that was 144C. Suppose he made the application to the DRC has given or passed the order, and according to the DRC order, here AO will again pass the modified order. The assessee will not be eligible to file any reference to the DRP or any appeal to the CIT appeal against the modified order. So always against the modified order guys, you cannot file any appeal. Now next part. Serving a copy of modified order to assessee. So AO has to serve the copy of modified order along with the notice of demand upon the assessee specifying the date for making the payment of demand. Suppose if there is a demand, suppose your variation, they have not reduced the variation, but they have given the immunity in the penalty or prosecution. So whatever according to the earlier variation, there was a demand now, so demand, you have to pay the demand. Now, so what this point says that serving copy of modified order to assessee, AO has to serve a copy of modified order along with the notice of demand upon the assessee, specifying the date of making the payment of demand, and no appeal or revision would lie against the modified order. I already told you that against modified order, you cannot file any appeal or revision. That is not possible. Now, next part. Assessee to furnish proof of demand, payment of demand. Suppose they have raised and they have asked to pay you some amount in the modified order, because suppose they have given you the immunity of the penalty or prosecution, they waive up the penalty, and also taxes you have to pay. Normal tax is interest you have to pay because suppose they have not changed the variation or they have changed the variation only little bit. So again, remaining variation you have to pay the tax and all na. So here, assessee has to furnish the proof of payment of the demand to the DRC and also to the AO. So here assessee will say that as per the DRC order, AO made the modified order and I have paid my demand, so this is the payment like proof. Now what here grant of immunity from the prosecution and waiver of the penalty. So DRC will give you the immunity from the penalty as well as the prosecution. So here DRC shall on the receipt of confirmation of payment of demand by order in writing grant immunity from the prosecution as well as they will waive the penalty if applicable. Now termination of dispute resolution proceeding means earlier suppose dispute resolution proceeding was there, but guys they will terminate it. When they will terminate it, DRC has the power that they can terminate it, they can cancel that. When DRC may at any stage after giving an opportunity of being heard to the assessee decided to terminate dispute resolution proceeding if assessee fails to cooperate during the course of dispute resolution proceeding. Assessee failed to cooperate. Assessee is not cooperating at all. Second is assessee fails to respond to or submit any information in response to notice issued to him. Suppose DRC asks you to file some information or document, you are not filing it at all. Or DRC satisfied that assessee has concealed any particular material or given the false evidence. Suppose DRC satisfied that assessee has concealed any particular material or given the false evidence. Or assessee fails to pay the demand as required in the notice of demand. Assessee is not paying the demand. In that particular case, DRC has the power that they can terminate the dispute resolution proceeding. Now, where the dispute resolution proceeding are terminated, the DRC has to intimate IT authority for taking the necessary action as per the provision of the Act. Now, next part. Power to reduce or waive the penalty or immunity from prosecution or both under the Income Tax Act. So, guys, DRC is having the power. Okay, DRC can give you the they can waive off the penalty as well as they can give you the immunity from the prosecution. But suppose against you already prosecution is initiated, means jail is already initiated, then they cannot give you any immunity. Means they can give the immunity only for the future prosecution. In the future there may be a jail, against that jail they can give you the immunity. But suppose for an example your jail is already initiated, means prosecution is already initiated, then against that prosecution they cannot give you any immunity. So here power to reduce or waive penalty or immunity from prosecution or both under the Income Tax Act 1961. Now, condition to grant of waiver of penalty or immunity from prosecution, DRC upon receipt of confirmation from the assessee of payment of demand should grant the waiver of penalty imposable or immunity from prosecution or both if it is satisfied that such person has paid the tax due on the written income in full if available, and guys cooperated with the DRC in the proceeding before it. So if assessee has cooperated, assessee has paid the taxes on whatever income, written income at least, then guys they will give you the immunity. Now, no immunity of prosecution proceeding were initiated before the date of receipt of application, means before the application to DRC against you. Suppose if prosecution proceeding is already initiated, then they will not able to give you immunity. Now next part. Withdrawal of immunity. If such person fails to comply with any of the conditions subject to which the immunity was granted, on such withdrawal, the provision of Income Tax Act 61 would apply as such immunity or waiver has never been granted. Suppose assessee has not complied with any condition which was necessary condition and assessee not complied, then guys they have the power that they can withdraw the immunity. Whatever immunity they have given earlier, this will be withdrawn. Now guys, effect of DRC order by AO that I already explained you here. Okay, when DRC will pass the order, then AO will pass the modified order. But question is that AO will pass the modified order in what time? So here, upon receipt of order of DRC, the AO shall, in case where specified order is a draft order or draft order or proposed order under section 144C. So if it was a draft order, then pass an order of assessment or reassessment or recomputation, or guys in any other case modify the order or assessment or reassessment or recomputation in conformity with the direction contained in the order of the DRC within 1 month from the end of the month in which such order is received. So guys, from DRC, if you receive the order from the end of that month, AO will pass within 1 month the final order and then he will send to the assessee. That is called your modified order. And against modified order you cannot file any appeal to any court and all. So guys, if when we file an application to DRC, so in the small cases, if there is a variation of 2 lakh, 3 lakh, 4 lakh and all, and a small assessee and variation is up to 10 lakh rupees, And assessee is a honest assessee, so he want that okay, whatever immunity I can get from the DRC, then he can apply to the DRC. And in the small cases, and assessee is not a bad assessee, assessee is a good assessee, assessee is a good assessee. Variation is only up to 10 lakh and his return income was only up to 50 lakh rupees, then he can request to the DRC, and DRC normally will give you the at least immunity in the penalty and prosecution they will give you. Variation they will reduce or not, that you don't know, they will check the everything and after that they decide, but at least they will give you the immunity in the penalty and prosecution. But after this DRC judgment, you cannot file any appeal further. So it is basically applicable in the case of the small assessees. Okay, so 1 3-mark question I can expect from in the examination. Now guys, directly check your compiler. So in your compiler, I think 3 questions are given from this topic. Just check the topic number 4, I think. Yeah, topic number 4. And in topic number 4, here DRC, dispute resolution committee. Dispute resolution committee, there are 3 questions. First question is very simple, second question also simple, third question is also simple. Now first question is, okay, what is the need of constitution of dispute resolution committee? What is the need of this? Can the assessee make the application before DRC against an order which is based on information received from foreign country under section 90 or 90A? So guys, what is the need of DRC basically? Like from 1st April 2021, a new scheme of the DRC is introduced by our government, and this is small cases. So in the small and medium taxpayer cases, if there is any like uncertainty or early resolution of dispute, they have provided the DRC concept. And suppose but order is passed as per the raid cases, survey cases or information under the section 90 or 90A of the DTAA, then assessee cannot file the application to DRC. So that is the answer of the question number 1. Now question number 2 is, can an assessee opt for dispute resolution before the DRC if prosecution of any offense punishable under the provision of the Indian Penal Code has been instituted against him and he is convicted under IPC? Guys, if he is convicted under IPC, then he cannot file the application to the DRC. He cannot file the application to DRC. And guys, question number 3. Guys, in question number 3, there is a one misprint of the line. So just write that. If you have the like in your book, I think this line is not written. Just write that line. कि Mr. Vijay furnish his return of income. Just write Mr. Vijay furnish his return of income and declared total income of rupees 28 lakh. Declared total income of rupees 28 lakh. So here Mr. Vijay furnish his return of income, declared total income of rupees 20 lakh. AO made the variation of the 5 lakh. So here guys, just mark this question as triple star, or you can say that the LDR. This question they may ask you in the examination. Okay, so just read all the 3 questions. I am going to give you some time, 2-3 minutes. Just read all 3 questions and just check the solution of all 3 questions. Okay, just do that. Yes, people, done. Any doubt? Manoj Raj, I think, hope so your doubt is clear. There is a variation in respect of total income, obviously, up to 10 lakh. So that 10 lakh is for the income, not for the taxes. Got it? Okay. So this is one topic we have completed. Now guys, one more topic we will take. That topic name is GAR. Directly check one topic. That is name is a GAR. GAR. Topic name is a GAR. GAR means General Anti-Avoidance Rules. GAR. But before doing the GAR, we will discuss the 4 terms, 4 words. One is the tax planning, one is the tax avoidance, one is the tax evasion, and one is the tax management. Now question is that, okay, sir, what do you mean by tax planning? What do you mean by the tax avoidance, tax evasion, and tax management? So I will explain you one by one. First is tax planning. So everyone asks you, your relative always asks you, okay, what do you mean by the tax planning? So always like you answer that tax planning, what to answer? Yeah, tax planning. So how to do the tax planning? So tax planning means, guys, utilization of exemption and deduction in the best possible manner. That is called tax planning. It's very simple. Utilization of best possible exemption and deduction. That is called your tax planning. You invested in ATC, you claim the ATD, you claim the deduction ATTTA, TTB. If you taken the housing loan, then 2 lakh rupees interest under house property. That is called your tax planning. Now we will discuss tax management. What is the tax management? Tax management is very simple. You just pay the taxes on the time, file the return on the time, pay the advance tax installment on the time, deduct the TDS on the time, just deposit the TDS on the next day, next month of the 7 up to 7. So this is called your tax management. So guys, tax management means like just do the compliance on the time, just file the return on time, pay the TDS on time to the government, as well as the deduct the TDS on the time, pay the advance tax on the time. So that is called your tax management. So what is the difference between management and planning? Planning is basically like possible best exemption deduction, claim that is called tax planning. Tax management means, guys, just do the compliance on the time. That is called tax management. Now, what is the meaning of the tax avoidance? Guys, tax avoidance is you are not violating the law. You are not violated the law. You are within the 4 corner of the law, but you are misutilizing the law. You are misutilizing the treaty. Treaty means a 2 country, they have the agreement, that is called treaty. So you are misuse the law, or you can say that you are using the loopholes of the law. That is called your tax avoidance. Tax avoidance means you are using the loopholes of the law. There may be a loopholes in the law, and you are just using that loopholes of the law and doing something and reducing your tax. That is called your tax avoidance. You know that Vodafone case law. Vodafone was one Netherlands-based company. In India-based company, there was a Hutch SR India, and Indian-based company sold in the Mauritius and Cayman Island. That one company CGP they have made, and that CGP they have made there only to not to pay the tax in India. So that is called your tax avoidance. Means you are using the loopholes of the law. You are not violating the law. You are not going outside the law. But guys, you are just you are using the law, misuse the law, or you can say that you are using the loopholes of the law. That is called your tax avoidance. Now, last is the tax evasion. Tax evasion means tax evasion is like not allowed in the law. What is the tax evasion? Tax evasion means illegally you are avoiding the tax. For an example, suppose you have claimed the fraud expenses, fake invoice you have taken, or suppose sales is not recorded, or any fake expenditure you have claimed. So that is called your tax evasion. So tax evasion, like if you did the tax evasion, there will be a penalty and all, there will be a prosecution and all. So penalty, prosecution, fines will be there if you are doing the tax evasion. So there are four words. One is the tax planning. Tax planning means utilization of exemption deduction in best possible manner. Tax management means do the compliance on the time. Tax avoidance means using the loophole of the law. And guys, tax evasion means this is like doing the fraud only, like you have debited some fraud expenses and fraud like income is not included in your income and all. That type of activity you are doing, that is called your tax evasion. You got my point or not? Yes. Just read this 4 point. After that, just do the question number 1 and 2 from your compiler. Just check the question number 1 and question number 2, question number 1 and question number 2 from your compiler. I'm going to give you 3-4 minutes time. Just do that. Just read 4 point. Just do the question number 1 and 2 from your compiler. Done, people? If you have done, then just say done. Say done, sir. If completed, then say done. Done, people? Yes. Now, guys, we are going to start with the topic GAR. This was 3 rule: tax avoidance, tax evasion, and tax management. Now, if you do the tax planning, we don't have any issue. Means our government don't have any issue if you do the tax planning, because this is intended. Government intention is there. Okay, you should use the ATC, 54, 54 EC and all. If you do the tax evasion, then obviously there will be a penalty, prosecution and all. Tax management, obviously that is the some different part. But government don't like the tax avoidance. Government don't like the tax avoidance. Government always want to restrict the tax avoidance, because many people were using the loophole of the law. Loopholes, or if there is a drafting mistake in the law, so they just use the loopholes of the tax law. That is called tax avoidance. So guys, how to counter the tax avoidance? So to counter the tax avoidance, our government came with various SAR. SAR means specific anti-avoidance rules. There are various SAR. SAR means specific anti-avoidance rules to remove the tax avoidance. Now, which are the SAR? Example is, if you remember, in the transfer pricing, whole transfer pricing topic is for SAR only, right? It is a SAR, specific anti-avoidance rules. But what people were doing, they are just shifting the profit outside India from the India. After, with the associate enterprise, they do the transaction as per their wish and all. So guys, whole transfer pricing topic is a SAR only. As well as, if you remember, in the PGBP, we have discussed that if you made any payment to your relative, then that payment will be allowed only to the extent reasonable, and it is going to be disallowed if there is a payment is like excess or unreasonable payment is going to be disallowed. If you see, we have discussed the 222E. So 222E, that is, if any closely held company gives the loan or advances to the shareholder, and that shareholder is having the 10% equity share in that company, then that loan or advances will be treated as deemed dividend to the extent accumulated profit of the company. So that is your like SAR. That is like already we have covered. There are some specific rule they have made. If you see, we have discussed that in the income tax, we have discussed various places, like you know that we have discussed 43.1 explanation about the actual cost. Okay, what companies used to do. Okay, suppose if there is a loss making company, then loss making company will sell asset to the profit making company and they will lease back. So if that type of transaction are doing, so there are already some specific anti avoidance rules. But guys, you know that our Indian mind are very sharp mind. Mala sharp mind, or you can say that the very corrupt mind basically. Along with the sharp, we are very corrupt. So we know that how to use the law. So again and again, you know that we always use the loophole of the law, and government fed up with the people of India. So what happened? Government started one new topic and new concept, that is called GAR. GAR is a general anti-avoidance rule. GAR is a general anti-avoidance rule. And in GAR, they are saying that there are various SAR in the income tax. There are specific anti-avoidance rules in the income tax. But guys, they have introduced the GAR because people were using the law. They are misusing the tax treaty, DTAAs and all. And they do the tax avoidance. So when government fed up with the people, then what government did? Government started imposing the GAR. GAR is a general anti-avoidance rules. And GAR is very simple. GAR says that from the assessment year 1819, this GAR is applicable from assessment year 1819. And under GAR, they have written that suppose you are doing the tax avoidance. If you are doing the tax avoidance and you are taking the tax benefit, and suppose that tax benefit is more than 3 crore rupees, means you are using the law, you are using the loophole of the law. And if you use the loopholes of the law, and guys, you are taking the tax benefit, and tax benefit of any arrangement is more than 3 crore rupees. Means there is a tax benefit from the any arrangement, and the tax benefit is a more than 3 crore rupees. And you are doing that transaction that generally people don't do in the normal practice. So you are just, that you are doing some cheating. Basically, you can say that you are planning some transaction in a way where normally people don't do in the practical life. Normally people don't do that type of transaction in the practical life, but you are doing that. There is a lack of commercials. There is a lack of commercial substance in the transaction. Means there is a lack of commercial substance in the transaction, and guys, your tax benefit you are going to take from that transaction is a 3 crore. Then our income tax department has the power that they will impose the GAR, and they will disregard that transaction. There may be possibility they will disregard that transaction. They will recharacterize that transaction, and guys, they will charge the tax from you. That is called GAR. But guys, till now, this topic is introduced from the assessment year 18-19, but till now they have not catch any case in the GAR till now, because this topic is a developing topic still. Because this topic will say you, suppose if any person is doing the tax avoidance, and in tax avoidance, if any he is within the law, but he is using the law, he is misusing the law, and there is a tax avoidance, and guys, he is taking the tax benefit of the more than 3 crore rupees. Means from that transaction, that tax benefit is a more than 3 crore rupees. Then guys, our government income tax department will treat that transaction as the impermissible avoidance arrangement. Our department will treat that transaction as a IAA, that is impermissible avoidance arrangement, and they will that disregard that transaction, or they will that lifting the corporate veil. If you heard that word, lifting the corporate veil, and they will recharacterize that transaction, and they will not allow to give you the tax benefit. They will not allow you to take the tax benefit. You got my point or not? Yes. So this is the GAR. We will understand this. Don't worry about that. We will do all the question from the GAR, because from examination perspective, GAR only you have to view the question, because there are various questions, and every year in examination, 3-mark question will be from this topic. In every year they ask the 3-mark question from this topic, but repeated question, we will do the question also today. Don't worry about that. First is the general anti-avoidance rules. Now, this section says that provision of this chapter apply in addition to or in lieu of any other basis of determination of the tax liability. So guys, this provision are in addition to whatever the normal provision are there, that provision is still there, but this provision are in addition to the whatever provision there are in the law. So what this point says, try to understand. This point says that, try to understand, wait a minute, here. So what this point says, provision of this chapter, that is GAR, shall apply in addition to or in lieu of or any other basis of determination of tax liability. And guys, there are a specific anti-avoidance rule called SAR. SAR would be applicable in the respective cases, but some example of SAR is like 48(2). If any payment is made to relative, then only reasonable payment is allowed. That is the SAR. Now 94A is related to transfer pricing. You know that transfer pricing 94A, we have discussed that if you are doing any transaction with the person located in NJ, notified jurisdictional area, and if any payment is made and all, then you have to deduct the 30% TDS and all. And 222E as well as the transfer pricing topic, that is called SAR, a specific anti-avoidance rule. Now guys, GAR override the provision of double taxation avoidance agreement also. So GAR is basically overriding the provision of your DTAA also. So DTAA provision also override by the GAR. So wherever GAR is applicable, then DTAA also not applicable. Normally what happens, normal income tax or normal income tax or DTAA, whichever is more beneficial, you can follow. But guys, if GAR is applicable, then GAR override the DTAA provision itself also. Now next part. GAR would be applied in respect of the tax benefit in aggregate by all the enterprise out of the arrangement in an assessment year exceeding 3 crore. Means if you are taking the tax benefit from the arrangement and that tax benefit is more than 3 crore, then only GAR is applicable. If that tax benefit is more than 3 crore, then GAR is applicable, and GAR provision are applicable from assessment year 18-19, but GAR is not applicable in case of the FIIs. Foreign institutional investor, GAR is not applicable in case of the FIIs. So here what they are saying, GAR is not applicable in case of the FII who has invested in the security in India with the prior permission of the competent authority and has not taken any benefit under the DTAA. So if there is like any FII, foreign institutional investor, and foreign institutional investor invested in India with the permission of the competent authority means with the permission of the RBI or any authority, and guys, with the competent authority permission they have invested in India, then on that FII this GAR topic is not applicable, and they have not taken any benefit in the DTAA, then GAR is not applicable. As well as the investment made by non-resident in offshore derivative instrument of the FII. So FII is having any offshore derivative instrument, and FII is having the instrument, and in that instrument if any non-resident invested, then guys, on that non-resident also GAR is not applicable. Now guys, when GAR will apply? So here this section says that applicability of GAR. GAR is applied when it will apply. Try to understand. So GAR provide that arrangement entered into by assessee may be declared as impermissible avoidance arrangement. Means whatever arrangement entered by the assessee, that arrangement may be treated as the impermissible avoidance arrangement, that is IAA, impermissible avoidance arrangement. And the consequence in relation to the tax arising there from may be determined as the provision of this section, as per provision of this section. So here guys, applicability of GAR, section 95 says that income tax authority has the power that they may treat any arrangement as an impermissible avoidance arrangement. Now when they will treat any arrangement as impermissible avoidance arrangement, we will discuss that. And guys, they may calculate the tax according to the provision of this chapter. Now the section start with the non-obsolete clause. Non-obsolete clause means this section start with the notwithstanding anything contained in any other provision of the law. It means this section is basically override whole income tax. If other provision is also applicable and this section is also applicable, then this section will apply. So here this section start with the non-obsolete clause. It means if there is a conflict with the provision of other section, then this section shall prevail over the other conflicting provision. So this section will be applicable. Now guys, when income tax department will treat your arrangement as an impermissible avoidance arrangement. So guys, here like income tax department may treat any arrangement wherever there is a tax avoidance. They may treat any arrangement as an impermissible avoidance arrangement if two conditions are satisfied. There are two conditions, and if two conditions are satisfied, then they may treat any arrangement as an impermissible avoidance arrangement. Now what are the two conditions? First condition says that the main object or main one of the reason of arrangement is to save the tax, that is the tax benefit, to get the tax benefit, and tax benefit is more than 3 crore. So first condition is that guys, the main purpose or one of the main purpose of which is to obtain the tax benefit, means assessee is obtaining the tax benefit. Assessee is doing to obtain the tax benefit. One or main purpose of the transaction is to obtain the tax benefit. That is the first condition. And second condition is guys, out of any 5, if there is any one tainted element is there. Means one condition, first condition is means person are entering into that type of transaction or arrangement only to get the tax benefit. And guys, second condition is any of the one tainted element out of the 5 element is there. Means out of the 5 element, there is any one element, one tainted element is there. Then guys, income tax department will treat that arrangement as an impermissible avoidance arrangement. Here, first tainted element is, suppose any person create any right or obligation which are not ordinarily created between the person dealing at the arm length. So guys, suppose main purpose is a tax benefit in the year is more than 3 crore. And guys, suppose any person is creating any right or obligation and which are not ordinarily created between the person dealing at arm length. Means suppose person are dealing at arm length, they are not creating that type of obligation or that type of right. But suppose in any transaction some right or obligation is created which are not ordinarily created between the person dealing at arm length. Second tainted element is, suppose if there is a result, directly or indirectly, you are misusing or abuse the provision of the act. Means you misuse the provision of the law or abuse the provision of the law. If you misuse the provision of the law or abuse the provision of the law, provision of the act include the DTAAs also. If there is a DTAA provision and you are misusing or abusing, then it will be treated as tainted element. Third is, Suppose if you entered or carried any transaction in a manner which are not ordinarily employed for the bona fide purpose, means people for the bona fide purpose don't enter into that type of transaction, but you are entering into that type of transaction, means people are not ordinarily employed for the bona fide purpose, entered into that type of transaction if you are doing that type of transaction. Or suppose if there is a lack of commercial substance, or there is a deemed to be lack of commercial substance. So if there is a lack of commercial substance or deemed to be lack of commercial substance, so in this particular case, guys, out of the 5, if there is any one condition, any one tented element, and guys, if you are doing for the take the benefit of the like tax benefit, and tax benefit is more than 3 crore rupees in a year, then guys, GAR may be imposed. Now we will discuss what do you mean by the lack of commercial substance. We will discuss certain example and all, but we will discuss after break. But before break, we will check certain question from your compiler. Just check the question from your compiler. Topic name is a GAR. That is 11th number topic. So here guys, topic 11, GAR. Question number 1, 2 already you have done. Now check the question number 3. Question number 3. Question number 3. All people pay attention. Just check the question number 3. Now question number 3 says that, suppose there is a merger of loss-making company with the profit-making company. Means there is a merger of loss-making company with the profit-making company, and result in the loss shifting to the profit making company. So lower net profit and lower tax liability after the merger. So would the losses be disallowed by applying the GAR? GAR can be applied here or not? Guys, in India, you know that merger, amalgamation and demerger and all. And if you know that amalgamation, demerger, you have to take the approval from the court. Means High Court give the approval, or NCLT give the approval. And NCLT check all the tax consequences and all. And only after checking all the tax consequences, they will give you the approval. So in this particular case, there is no need to invoke the GAR, because guys, there are specific provisions related to amalgamation, and amalgamation we allowed that amalgamating companies' losses will be allowed to the amalgamated company and all. And there is a, like, you know, that there should be approval from the court, and court always check that is there is a anything is a, like extra tax tax benefit and all, everything will be checked by the court. So in this particular case, there is no need of the GAR. So here what this point says, try to understand. As regard to setting of the losses, the provision relating to merger and amalgamation already contain the specific avoidance for safeguard. Therefore, GAR need not be invoked when SAR is applicable. Though as per the CBDT circular, but guys, what happened? One of the CBDT circular says that GAR and SAR can be coexistence also. So for the amalgamation case, there are various specific anti-avoidance rules already there in the law. So they are saying that when SAR is there, then there is no need of the GAR. But as per the CBDT circular, GAR and SAR can be coexist. So here what you will write, guys, if there is an amalgamation, then for the amalgamation and all, there is already specific anti-avoidance rules are there in the law. And when SAR is applicable, then there is no need of the GAR. But after that, you will always write as per the CBDT circular, GAR and SAR can be coexist also. That you have to write. Now further, since the merger and amalgamation would be carried out under the order of the NCLT, the GAR need not be invoked if NCLT has explicitly and adequately considered the tax implication while sanctioning the merger scheme. So merger scheme will be sanctioned by the NCLT, and NCLT has did everything. If they did all the tax consequences and all, they have already considered in the, and NCLT do that. So guys, there is no need of the GAR. Now there is a question number 4. What question number 4 says that? Try to understand. Question number 4 says that, suppose a choice is made by company for acquiring an asset on the lease over the outright purchase. So assessee is having the option. Either he can take the asset on the lease or he can outrightly purchase the asset. Now what happened? The company claimed deduction for lease rental in case of the company claimed deduction for lease rental in case of acquisition through the lease rather than the depreciation, as in case of purchase of the asset. would the lease rent payment being the higher than the depreciation be disallowed as expenses under GAR? So guys, for an example, like assessee has an option कि either purchase the asset or take the asset on the lease. He is having the option. Now he can exercise any option. Suppose he has taken the asset on the lease. So lease rent is higher as compared to the depreciation. So question is that can GAR can be imposed here? Answer is no. GAR should not be, because that is an option to the assessee. Na? Is assessee is misusing the law? Answer is no. Because in the income tax they clearly mention that if you taken the asset on the lease rent will be allowed. If you purchase any asset and then depreciation will be allowed. So is assessee is doing anything unfair? Is the assessee is doing avoidance of the tax? Answer is no. So when assessee is not avoiding any tax here and choice is given, then assessee can take any choice. This is given in the income tax law. So here guys, there is no need of the GAR. So what this particular point says, try to understand. Here, GAR provision would not apply in case as the taxpayer merely makes the selection out of the option available to him under the provision of the act for which he is eligible and satisfied the stipulated condition, if any, even if the choice of such options result in the lower tax liability, the same is a result of the tax planning. This is the tax planning, na? Because both options are given in the law. Okay, you can purchase the asset or you can take the lease. If you taken on the lease, then you can allow the lease rent, obviously. And if you purchase the asset, then depreciation will be allowed. After that, question number 5, ignore just. Question number 6 also ignore. Just check the question number 7. Just check the question number 7. What question number 7 says? Just check the question number 7. Question number 7 I have taken from the past RTP. That is RTP. Pay attention. Question number 7. What question number 7 says? Question number 7 says that examine whether the GAR can be invoked in the following cases or not. Can GAR can be invoked in the following cases or not? So here, point number 1. Point number 1 says that Messrs Footprint Limited is a company incorporated in India. So this is one Indian company. Set up a unit in the SEZ, Special Economic Zone, for manufacturing of water bottles. So they are manufacturing water bottle in the SEZ. It claims 100% deduction of profit earned from unit as per the section 10AA of the Act. So guys, there is an Indian company. They are manufacturing water bottle in the SEZ and they claim the 100% deduction for the first 5 years. Is they are doing anything wrong? Just tell me, is they are doing anything wrong? Here, Footprint Private Limited is a company, manufacturing company. They manufacture the water bottle in the SEZ. They sell the water bottle, means they export the water bottle. And guys, they are claiming the deduction. So question is that 10AA deduction, is they are doing anything wrong? Answer is no. 10AA deduction is allowed by the lawmakers. Na? By 10AA deduction, Nidhi 10AA deduction is allowed by the lawmaker. Lawmaker says that you can take the 10AA deduction for the first 5 year 100%. For the second 5 year, there is a 50%. For the third 5 year, there is a 50% of export, 50% of export profit or SEZ reinvestment reserve, whichever is lower. So this benefit is given by the lawmakers. Now what assessee is not doing anything wrong? Here assessee is not doing anything wrong. Now here assessee is not doing anything wrong. So in this particular case, guys, there is no need of the GAR now here. So pay attention. Point number 1. There is an arrangement of setting a unit in SEZ which result in the tax benefit, but however, this is the case of the tax mitigation where taxpayer is taking benefit of the fiscal incentive offered to him by the complying with the condition imposed and economic consequences of the provision in the legislation. Example, that is setting up and business unit in the SEZ area. Hence, revenue would not invoke the GAR as regard to this arrangement. Now, guys, what happened in the second part? Second part is interesting. And this part was the this time examination paper, November 2023 examination paper. This second point, this was for the 3 marks. 3 marks. This question was for the 3 marks. Now, what happened? Pay attention. Suppose in the above case, like assessee has set up the unit in the SEZ. But what happened? Let us presume that Footprint Limited has another unit for the manufacturing of water bottle in the non-SEZ. Now guys, they are having one unit in the SEZ and they are having one unit in the non-SEZ. Non-SEZ means suppose Mumbai is a non-SEZ. Suppose in Surat, there is a SEZ. Surat, there is a SEZ. Mumbai, there is a non-SEZ. Now what happened? The company transferred the product of non-SEZ unit to the SEZ unit at a price lower than the fair market value. So suppose here what happened, this non-SEZ unit transferred the asset transfer the, they made the sale to the SEZ unit, and guys, they are selling at lower than fair market value. Lower than fair market value. They are selling at lower than fair market value. So what happened here? In respect of such product transferred from non-SEZ unit, only insignificant manufacturing activity take place in the SEZ unit. So in SEZ unit, on that bottle, they will do the manufacturing unit activity, but very less activity will be in the SEZ unit. In this way, the company is able to show the higher profit in SEZ unit than in non-SEZ unit, and consequently claim the higher deduction in computation of income. The sales from bottle transferred from non-SEZ unit contain 10% of total turnover of SEZ unit. Now guys, what happened? In the non-SEZ unit, you did some activity, and after that you transferred to the SEZ unit. In SEZ unit also you did some activity. And guys, after SEZ unit, you did some manufacturing activity, and you have exported that bottle. You exported that bottle. And guys, what happened when you purchase from here now? Then you purchase at lower price than the market value. So what happened in SEZ? Your profit will be increased, and SEZ profit there will be 100% deduction. And in the non-SEZ, your profit is decreased. So here you have saved the tax. So guys, for this type of transaction, you know that in income tax, there are already specific anti-avoidance rules. There are already SAR is there. Already SAR, that is SAR is already there. Specific anti-avoidance rules is already there. And if you remember the transfer pricing, in the transfer pricing, I have mentioned that, okay, guys, specified domestic transaction. And in the specified domestic transaction, they have mentioned that, okay, suppose your one unit is located in the SEZ and one unit is located in non-SEZ, then whatever transaction took place, now that should be on the arm length. That should be on the fair market value. And guys, if you're not on the fair market value, then you have to bring that on the fair market value. So guys, for this type of transaction, there are already SAR is available. Already SAR is available, so there is no need of the GAR. But as per the CBDT clarification, GAR and SAR can be coexistence. So here you have to write that, okay, guys, for this type of transaction, already there are SAR, specific anti-avoidance rules, already there. And this transaction should be on the fair market value only. If it is not on the fair market value, they will bring it on the fair market value. And guys, SAR is already there, so there is no need of the GAR. But however, as per the CBDT clarification, GAR and SAR can be in coexistence. So that should be the answer you have to write. So here, as there is no misrepresentation of fact or false submission, it is not a case of the tax evasion. What happened here? The company has tried to take advantage of the tax provision by transferring profit from non-SEZ unit to the SEZ unit. This is not the intention of providing the tax benefit of the unit in setup in the SEZ. However, such tax avoidance is specifically dealt with section 10 AA subsection 9, read with the section 80 IA subsection 8. Wherein inter alia it is provided that where any goods or services held for the purpose of any other business carried on by the assessee are transferred to the eligible business, and the consideration, if any, for such transfer is recorded in the account of the eligible business does not correspond to the market value of such goods or services as on the date of transfer, then for the purpose of deduction under this section, the profit or gain of such eligible business shall be recomputed as if the transfer in either case had been made at the market value of such goods or services as on that date. So guys, to deal with this type of transaction, there are already provisions in the Income Tax Act. There are already provisions in the Income Tax Act. So in this particular case, there is no need of the GAR. So here, thus in this case, due to the application of the SAR, no tax benefit can be derived by the Footprint Limited by transferring the product from the non-SEZ to SEZ, because if they are doing it, then they will impose the SAR. So SAR is already there, so there is no need of the GAR because they will not take any benefit here. SEZ unit at less than fair market value. Therefore, there is no specific need of the invoke, but as per the CBDT clarification, that provision of GAR and SAR can be in coexist and the made applicable as may be necessary considering the fact and circumstances of the case. The possibility of invoking GAR in this case cannot be completely ruled out because CBDT says that GAR and SAR can be coexistent, but here there is a SAR, specifically SAR is there, so SAR will apply. Done. So this is the question. This was one question they asked in this time paper, 3-mark question, the second question. Okay, done. So now just take a break for the 10 minutes, and after 10 minutes we will start with the next part. So just take a break for 10 minutes. All people, take a break for 10 minutes.